After studying this module, you shall be able to understand the constitutional provisions relating to budget, differentiate between various funds under the budget and concepts relating to budget, identify difference between revenue budget and capital budget, understand as to how Parliament and state assemblies exercise their control over budget through various committees.
The budgetary operations of the government have a significant bearing on the functioning of the economy. Over the years, the budget has become increasingly important due to the introduction of economic planning. Government has emerged as an essential sector due to the increase in the magnitude of government spending.
The government sector has its own money inflows and outflows. Inflows are through the revenues from tax and non-tax sources and from borrowings. The outflow is for expenditure on various administrative, social, and economic activities. The manner in which resources are collected and the pattern of their spending influence savings and investment level, distribution of income and wealth, allocation of resources, and the consumption behaviors of people. In addition, the government has to manage the problems of inflation, fluctuations in the economic activities, fiscal deficit, and other macroeconomic variables. The government budget plays an important role in the management of these aspects and in realizing objectives of fiscal policy. Thus, the budget of government is a document giving description of the fiscal policies of the government with corresponding financial plans.
Constitutional provisions relating to the budget. In terms of the constitutional provisions, the budget is an annual statement of the estimated receipts and expenditure of the government. Under Article 112 of the Constitution, the budget is prepared and is presented by the central government before the Parliament in every financial year. Under Article 202 of the Constitution, the state governments prepare a statement of the estimated expenditures and receipts of the state and lay before the respective legislative assemblies. The annual financial statement prepared by the central government is titled as Budget of the Union Government, and the financial statement prepared by the state governments is known as Budget of the concerned state government. The annual financial statement is a core budget document that presents the estimated receipts and disbursements of the government. The budget of the government sets forth receipts and expenditures of the government for 3 consecutive years. For instance, number 1, the details of the actual receipts and expenditure for the preceding year. Number 2, revised estimates for the current year. And 3, the budget estimates for the coming year. The revised estimates of the current year are based on the actual trends in the revenue and expenditure of the 9 months of the current year with existing rates of taxes and expenditure policies. The budget estimates for the coming year are presented on the basis of the proposed changes in these components. The budget is accompanied by an explanatory memorandum which provides reasons for the major change, if any, in the last year's revised estimates.
Documents relating to budget. In addition to the annual financial statement and the explanatory memorandum, the budget contains some documents that are mandatory to be prepared and presented before the Parliament as per the provisions of the Constitution of India. All these are called budget documents. Budget documents include the Finance Minister's budget speech, budget at a glance, demand for grants, finance bill, appropriation bill, supplementary grants, fiscal policy strategy, and highlights of budget. Let us now discuss funds under the budget. The Constitution of India provides for the creation of 3 separate funds in the budgets of both the union and state governments. These are Consolidated Fund of India, Contingency Fund, and the Public Accounts. Consolidated Fund: all revenues received by the government, all loans raised by the government by the issue of treasury bills, loans, or ways and means advances, and all monies received by the government in repayment of loans from the Consolidated Fund of India. No amount can be withdrawn from Consolidated Fund without authorization from the Parliament. The state governments also follow the same procedure. The expenditure incurred from Consolidated Fund will be with due sanction of Parliament and in accordance with the law and for the purpose and in the manner provided in the Constitution.
Contingency Fund. Parliament may by law establish a contingency fund in the nature of an impress to be entitled the Contingency Fund of India. The fund shall be placed at the disposal of the President of India or the Governor of the state, as the case may be, to enable advances to be made for the purpose of meeting unforeseen expenditure pending authorization of such expenditure by Parliament or state legislature. The amount spent from contingency fund is to be replenished with the beginning of the new session of Parliament or Assembly.
Public accounts. All other public monies received by or on behalf of the Government of India or the Government of a state is credited to the public accounts of India or the public accounts of the state as the case may be.
For instance, transactions relating to the provident funds, small savings certificates, etc., belong to the category where the government acts more as a banker. This money, as a matter of fact, does not belong to the government and have to be paid back sometimes or the other to the persons who deposited them. Therefore, these receipts are kept in the public accounts and the concerned disbursements are also made therefrom. It is a liability for the government. Government can borrow from this fund in case of need. Parliamentary authorization is not required for transaction from the public accounts.
Concepts relating to budget. Various concepts are used in relation to budget. Some important concepts are vote on account, supplementary budget, interim budget.
A vote on account may be sought when a change in the government takes place shortly before the end of a financial year. The new government may wish to recast taxation and expenditure proposal to reflect its own policies through the budget, and it may find the time at its disposal inadequate to effect the desired changes. Under such circumstances, the Parliament may be approached to pass a vote on account providing sufficient grants to enable the government to incur expenditure till the appropriation bill is passed. In this case, a vote on account becomes an ordinary statement of estimated revenues and expenditures at the existing rates of taxation. In other words, it does not contain any taxation proposals. It just enables the government to withdraw funds from the Consolidated Fund of India till a regular budget is presented and passed by the Parliament. Under normal circumstances, the vote on account is sought for 2 months for a sum equivalent to 1/6 of the estimated expenditure for the entire year. However, during an election year, the vote on account may be taken for a longer period, say 3 to 4 months, if it is anticipated that the appropriation bill will take longer than 2 months to be passed by the House. A vote on account is passed by the Parliament after the general discussion on the budget is over and before the discussion on demands for grants is taken up. Traditionally, vote on account is treated as a formal matter and passed by the Parliament without discussion. Supplementary budget. It is likely that the forecast on the basis of which the original budget was prepared go erratic due to exogenous factors like international economic crisis or international disturbances such as industrial unrest, political instability, etc. Government may then present to the Parliament a supplementary budget to deal with such shocks. Furthermore, if a grant voted by the Parliament in accordance with the estimates presented in the budget for a particular service for the current financial year is found to be insufficient for the purpose of that year, the government presents a supplementary estimate and the Parliament may make a supplementary grant. Also, the government may approach the Parliament when the need arises during the current financial year for supplementary or additional expenditure on some new service not contemplated in the budget of that year. The supplementary demands for grants are presented to and passed by the House before the end of the financial year.
Interim budget. While a vote on account deals only with the expenditure side of the government's budget, an interim budget is a complete set of accounts including both expenditure and receipts. An interim budget gives the complete financial statement, very similar to a full budget. While the law does not debar the government from introducing tax changes, normally during an election year, the existing governments have avoided making any major changes in tax laws during an interim budget. Let us now discuss the budget components. The estimates of budget are made under two main divisions, viz. Revenue budget, all direct and indirect taxes, non-tax receipts, and interest on loans and advances received and revenue expenditure, and capital budget, internal debt, external debt, and repayment of loans and advances, expenditure on creation of assets, and other capital expenditure. Revenue budget. The revenue budget has revenue receipts and the expenditures on revenue account of the government. Revenue receipts. All the government receipts of recurring nature may be termed as revenue receipts. These receipts are divided under two heads: 1. Tax revenues, and 2. Non-tax revenues. Tax revenues comprise proceeds of taxes and duties levied by the Union under Union budget and by the states under state budget. Union taxes will appear in Union budget and state taxes will appear in state budget. Non-tax revenue of the governments mainly consists of interest and dividends on investments made by the government, and fee and other receipts for services rendered by it. The important taxes of the central government include income tax, corporation tax, gift tax, wealth tax, customs duties, and union excise duties. Besides these, there are other taxes such as additional customs duty, additional excise duty, etc. The government also receives return from resources at its command, fee for specific public services, and profit from the public sector undertakings. Non-tax revenue receipts are classified under three broad heads: A. Interest receipts, B. Dividends and profits, and C. Other non-tax revenue. Let us now take a look at the revenue expenditures. Expenditure incurred on functioning of government departments and for provisioning of various social services, interest charges, and any other expenditure incurred by the government, and grants given to state governments and other departmental and commercial undertakings. In general, all government expenditures, if not resulting in the creation of physical or financial assets, may be treated as revenue expenditures. Let us now analyze the components of revenue budget of central government. Total revenue receipts comprises of tax revenue, which consists corporation tax, income tax, customs tax, and excise duties. It also consists non-tax revenue, interest receipts, and dividends and profits. Total revenue expenditure has non-planned revenue expenditure that includes interest payment, defense and major subsidies, and planned revenue expenditure that consists central plan and central assistance for state plans. Capital budget. Capital budget also has two components comprising capital receipts and capital expenditures of the government. If capital receipts fall short of capital requirements, the deficit will occur that may be financed through the short-term borrowing from RBI or market and/or drawing down of cash balances. Higher the amount of capital raised by public authorities, less resources are available for the private sector due to crowding out effect as the total resources at a point of time are given. Capital receipts. Capital receipts of the government create liability or reduce financial assets. To finance capital requirements, major sources are revenue surplus, market borrowing from the domestic markets, loans from RBI, small savings, recoveries of loans and advances, receipts under state provident funds and public provident funds, special deposits, external assistance, and external borrowings. Other loans and disinvestments of equity holding in public enterprises, and other receipts. Capital expenditure. Government's expenditures that create physical or financial assets or reduction in recurring financial liabilities are called capital expenditure. For example, expenditures made for acquisition of assets like land, buildings, machinery, equipment, as also investments in shares and loans and advances given to state governments, public sector enterprises, and other institutions. Let us now look at the components of capital budget of the central government. On the left side of table, we have total capital receipts, which is financed through money borrowings, special deposits, recoveries of loans, external assistance, state provident fund and general provident fund, small savings, etc., other receipts and other loans. On the right side of the table, we have total capital expenditure, which has two parts. A. Non-planned capital expenditure that includes defense, loans of public enterprises, union territories and states. B. Planned capital expenditure which relates to central plan and central assistance for state plans. Plan budget. Like revenue and capital budget, there is a component in the budget that relates to planning aspects. Accordingly, the revenue expenditure is planned revenue expenditure. Planned revenue expenditure pertains to expenditure for central plan and central assistance for states and union territories. Similarly, capital expenditure is also a planned capital expenditure. Planned capital expenditure relates to central plan and central assistance for state and union territory plans. Parliamentary control over the budget. Parliament, Legislative Assembly, exercises control over both receipts and expenditure of the central and state governments. By passing finance and appropriation bills, the Parliament, Legislative Assembly, authorizes the government to collect revenues and spend money. The authority of the Parliament or Legislative Assembly is not limited only to sanctioning appropriations, rather, it has the means to ensure that the appropriations have been applied towards the purposes approved and within the limits imposed.
For the sake of completeness of legislative control, the Parliament or Legislative Assembly constitutes three financial components, namely the Public Accounts Committee, the Estimates Committee, and the Committee on Public Undertakings. The members of the committees are elected every year from among us the members of the Lok Sabha according to the principle of proportional representation by means of a single transferable vote. The chairman of the Estimates Committee and the Committee on Public Undertakings is appointed by the Speaker from among us the members of the Lok Sabha or Legislative Assembly elected to the committee. The term of the office of the members of the committee is 1 year.
Public Accounts Committee. Let us briefly describe the functioning of this committee. It is a parliamentary legislative assembly committee with a non-official chairman appointed by the Speaker from amongst the members elected to the committee. The committee consists of members from both the houses. It scrutinizes the accounts and audit reports prepared by the Comptroller and Auditor General at state level to satisfy itself that a. The money shown in the accounts as having been disbursed were legally available for and applicable to the service or purpose for which they have been applied or charged. B. The expenditure conforms to the authority which governs it. And C. Every reappropriation has been made in this behalf under the rules framed by a competent authority. Estimates Committee. The purpose of the Estimates Committee is to ensure that public expenditure is incurred in a judicious manner and that the objectives underlying the plans and schemes are effectively achieved. It also suggests economy and efficiency in public expenditure. In a sense, it is a mechanism to extend parliamentary control over government expenditure beyond the granting of appropriations. Committee on Public Undertakings. In the wake of industrial policy resolutions of 1948 and the subsequent 5-year plans, the Committee on Public Undertakings was set up in 1964. The committee is charged with the task of scrutinizing the reports and accounts of public undertakings, the reports of the Comptroller and Auditor General of India or AGs at state level on such undertakings, and to suggest economies, improvements in organization or management and production that could be effected in various undertakings. Committee on Public Undertakings consists of 22 members. The findings of the committee on a subject are contained in its report, which is presented by the chairman to the Lok Sabha or Legislative Assembly. A copy of the report is also laid on the table of the upper house. Indian economy, faced with the problem of large fiscal deficit and its monetization spilled over to external sector in the late 1980s and early 1990s, the large borrowings of the government led to such a precarious situation that government was unable to pay even for 2 weeks of imports, resulting in economic crisis of 1991. Consequently, economic reforms were introduced in 1991 and fiscal consolidation emerged as one of the key areas of reforms. After a good start in the early 90s, the fiscal consolidation faltered after 1997-98. The fiscal deficit started rising after 1997-98. The government introduced Fiscal Responsibility and Budget Management Act 2003 to check the deteriorating fiscal situation. The FRBM Act aims at ensuring intergenerational equity in fiscal management, long-run macroeconomic stability, better coordination between fiscal and monetary policy, and transparency in fiscal operation of the government. The FRBM rules of July 2004 specify the annual reduction targets for fiscal indicators. The FRBM rule specifies reduction of fiscal deficit to 3% of the GDP by 2008-9 with annual reduction target of 0.3% of GDP per year by the central government. Similarly, revenue deficit has to be reduced by 0.5% of the GDP per year, with complete elimination to be achieved by 2008-9. It is the responsibility of the government to adhere to these targets. FRBM Act provides a legal institutional framework for fiscal consolidation. It is now mandatory for the central government to take measures to reduce fiscal deficit, to eliminate revenue deficit, and to generate revenue surplus in the subsequent years. The Act binds not only the present government but also the future government to adhere to the path of fiscal consolidation. The government can move away from the path of fiscal consolidation only in case of natural calamity, national security, and other exceptional grounds which central government may specify. The Act prohibits borrowing by the government from the Reserve Bank of India, thereby making monetary policy independent of fiscal policy. The Act bans the purchase of primary issues of the central government securities by the RBI after 2006, preventing monetization of government deficit. The Act also requires the government to lay before the Parliament three policy statements in each financial year, namely medium term fiscal policy statement, fiscal policy strategy statement, and macroeconomic framework policy statement. To impart fiscal discipline at the state level, the 12th Finance Commission gave incentives to states through conditional debt restructuring and interest rate relief for introducing fiscal responsibility legislations. All the states have implemented their own FR.
The implementation of Fiscal Responsibility and the Budget Management Act improved the fiscal performance of both the center and the states. The states have achieved the targets much ahead of prescribed timeline. The government of India was on the path of achieving this objective right in time. However, due to the global financial crisis, this was suspended. The financial consolidation as mandated in the FRBM Act was put on hold in 2007-2008. The crisis period called for increase in expenditure by the government to boost demand in the economy. As a result of fiscal stimulus, the government has moved away from the path of fiscal consolidation. However, it should be noted that strict adherence to the path of fiscal consolidation during the pre-crisis period created enough fiscal space for pursuing counter-cyclical fiscal policy. Let us now summarize what we have learned in this module. The budgetary operations of the government have an important bearing on the functioning of the economy. The government sector has its own money inflows and outflows. Inflows are through the revenues from the taxes, non-tax sources, and from borrowings. The outflow is for the expenditure on various administrative, social, and economic activities. A statement of estimated receipts and expenditures of the government is known as budget. It sets forth receipts and expenditures of the government for 3 consecutive years. For instance, the details of the actual receipts and expenditures for the preceding year, B. the revised estimates for the current year, and C. the budget estimates for the coming year. The documents, those are mandatory to be prepared and presented before the Parliament as per the Constitution of India, are called main budget documents. Some of the budget documents are annual financial statements, demand for grants, finance bill, appropriation bill, and supplementary grants of the Constitution of India. The receipts and disbursements in the budget are shown in 3 parts for which the government accounts are maintained: the consolidated fund, the contingency fund, and the public accounts. The contingency fund is placed at the disposal of the President of India or the Governor of the concerned state, as the case may be, to enable advances to be made for the purpose of meeting unforeseen expenditure pending authorization of such expenditure by Parliament or state legislature. All other money not forming part of the consolidated fund received by or on behalf of the government are credited to the public account. It is a liability for the government. Government can borrow from this fund in case of need. There are various concepts that are used in relation to budget, such as vote on account, supplementary budget, and interim budget. While a vote on account deals only with the expenditure side of the government's budget, an interim budget is a complete set of accounts including both expenditure and receipts. The budget is made in 3 main heads. For instance, the revenue budget, the capital budget, and plan budget. The revenue budget includes revenue receipts having all direct and indirect taxes, non-tax revenues, and interest on loans and advances, and revenue expenditure. Capital budget includes internal debt, external debt, repayment of loans, and advances as capital receipts. Capital expenditure is on the creation of assets and other expenditure of capital nature. The government introduced fiscal responsibility and budget management, that is FRBM Act 2003, to check the deteriorating fiscal situation. The FRBM Act aims at ensuring intergenerational equity in fiscal management, long run macroeconomic stability, better coordination between fiscal and monetary policy, and transparency in the fiscal operations of the government.